Hi, once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bowling with you, and I am joined by Joe Camp of Comstock Investments. We're going to take a look at Wednesday's ag commodity markets and maybe a few extra things as well. Make sure you like this video, subscribe to it, hit that bell icon down below, and share this video with others to help spread the message that we're putting out. All right, now, Joe, let's take a look at Wednesday's trade. The gold star apparently goes to the wheat trade on Wednesday. What's up?
We've been calling wheat the anchor of the market here, and all of a sudden this week providing some leadership. So a good turnaround there. Wheat's a world crop, of course, one that's most heavily traded and can provide a direction for the broader grain market. And it has so far this week. It was a strong close on Friday for the grains, picked up where they left off on Monday. No turnaround Tuesday, so it was 3 days up in a row. For wheat, another day higher here, but corn and soybeans fell off into the close. I think a little bit of profit taking on the corn after a negative ethanol report, some lingering concern there after a string of weaker numbers. There's overall a bit of worry about the economy as we head into the new driving season and the shape of consumers in the face of pretty high fuel prices. That's showing up in the numbers, but ultimately, it's also a case of watching the weather and this forecast for planning. We know we've got a wetter weekend ahead, but that opposes to what is one, both better moisture and some progress that's rapidly advancing on a day like today, at least for some.
Joe, you put together a May Chicago wheat chart, a bar chart here. I believe this is a daily chart. And on that chart, it looks like we blew out some overhead resistance lines. Explain what we're looking at.
Early signs of a breakout. Anytime you're going to move over a couple of key highs like we did from earlier in the year, also poking above the upper Bollinger Band in a way that spreads those volatility indicators out and for the upper band back higher. You've got some bullish crossovers of the shorter term momentum studies. We have both of those in blue on the chart I prepared, the 20-day holding above the 30-day, but the more important moving average up top about where the market's at, a little below now, which is key. This nearby March Chicago contract now back above its 100-day moving average for the first time, testing that line since January. So a breakout here on the chart that's starting to gain some notice. One, it triggers stops to take profit, further short covering here on the momentum, but there's work to do, and we line out a couple of key points ahead where we can find some potential upside interest, also potentially pushback from resistance on these Fibonacci retracement levels around 637 for the 38% retracement. Another important level being marked out in purple around 668, a 50% retracement of the move down from these summer highs, just a tick below $8 last summer. If we were to get back above that level, you can see there's also a high there from late last year, and that would go a long ways in reversing what is still a broadly significant downtrend. So we'll see. It's a helpful motivation and has been all week here for the grains, this breakout technically for wheat.
On the latest drought monitor map, it does show about all of Kansas in some form of a dry streak again, moderate drought perhaps, but even some areas of Iowa seem to be very dry. What's going on anyway?
Right, and that is one of the influences we got to talk about for wheat. It started off in a way sparked by more in the war in Ukraine, attacks on that Odessa port and grain infrastructure owned by Ukraine. There was some talk about Russian wheat prices as well moving higher because of dryness there. But now it's dryness in the southern plains again that have us thinking about what could potentially be lost and relative to earlier expectations on this hard red winter wheat crop. So the condition ratings dropping on the national level, good to excellent, down 5 points last week. 50% good to excellent is still almost double where they were a year ago. But it's a quicker deterioration for that hard red wheat out there in the Texas Panhandle and Kansas and Oklahoma. And you mentioned the drought that's lingering there and now expanding again. We were really optimistic about the way this winter looked and the abatement of drought for a couple of months, yet we're backtracking here. And it's not just Kansas, as you mentioned. You spread up into eastern Nebraska, northern Missouri, up through a lot of Iowa and into Minnesota and Wisconsin. And this gets into, if you will, what we're talking about in terms of planting progress, whereas we can show to date the numbers for corn and soybean seedings, and there's no alarm at this point. But it's in part because those that have been able to plant are in these spots where it's awfully dry and has been for some time. So that's a big risk going forward, that it stays dry. Even if they can continue to plant, it's because they're not getting much in the way of this moisture. That could, again, change this weekend, crossing our fingers on that.
You have accumulated a couple of what I call dot plot maps related to corn and soybeans, and it correlates how their end of the year yield comes out related to what date they are planted, doesn't it? Explain what we're looking at. Let's look at the corn planting date dot plot map first.
These are a couple of maps that I'm going to include in the Comstock report for my article this Friday, and it comes from a Farm Doc Daily report. U of I economist Scott Irwin authoring a look at how planting progress impacts yield. And there were a few key takeaways from that research. One being that we're just starting in so many places, including Illinois, where the study was based, but across most of the Midwest, just entering into those optimal planting windows. And that's why we're always talking about planting progress and potential delays, with the caveat of it only being April yet, not any concern here. And that's one of the key findings, that it doesn't get until the middle of May or later where you start to really see concern over yield impact. But if you look at the chart, you can see pretty clearly beyond mid-May in Illinois. Now push that back a week as you go further north, up to 2 weeks into the upper plains and the northern Midwest. But it's beyond that point where you can start to see the yield impact drop off considerably. So we're looking at corn and the impact there. If you bring up soybeans, the decline is even faster. We know how dependent soybeans are on getting that sunlight, and now we're counting down already the days until the next solstice. For that crop, you get past the ideal planting window, and they're going to drop off a lot further. Again, no real concern if you look at the crop progress numbers to date, but also if you bring into the mix the outlook, the forecast for some areas of the country, a lot of that being east of the Mississippi River, where they don't quite have the start like the West does, where they're awfully dry, as we showed in the drought monitor. You're going to see some concern after we get out of this month, which we're almost out of here, but still in April is the back and forth of it, and still also the trade-off between potential planting delays ahead, but also the very much welcomed moisture that we're getting in those areas that are receiving it.
Now, I see you also have a couple of maps here related to the weekly crop progress report. And in this case, it would be the crop planting progress report. You have one for corn planting progress, and you have plotted out on this map what the pace is this year, what it was last year, what the average was. Walk us through that and how they compare to the 5-year average.
These were something we posted on the Facebook page. It's something that readers like to look at just to generally see who's doing what. And what we can tell is with a national average at 12%, that's 2 points ahead of the 5-year average in its early stages and just ahead of an average pace. Again, no real alarm. But if we start to look at the different regions, we can see again, it's these states like Kansas into Missouri, Iowa, Minnesota, where they have had relatively more advancement for planting relative to the eastern corn belt, where it's been wetter and where it looks like it could potentially remain wetter as we finish out this spring at least. We do also see, though, that they were able to, by and large, catch up after a delayed start in the southern delta, and that there's no real laggard or any thing that stands out for the South as well. So corn we talked about, but it's similar for soybeans. Maybe a little bit more advanced, where you have an 8% national average through last Sunday compared to a 4% 5-year average. So double the pace here, something that can, again, change pretty quickly depending on how this forecast holds up or not, given that a lot of the country does look to receive some rain here Friday through early Monday at least.
Well, now I want to ask you what happened to livestock here on Wednesday. The cattle market kind of fell out of bed. How come?
In part, it's a market where it's going to be very much a stretch if you're going to see 3 or 4 days up or down in a row in any of these markets. As choppy as we've talked about this trade having been, it is the case that cattle had a good start to the week, like for grains, where they followed up on a solid finish last week, ultimately reflecting for the cattle a bullish cattle on feed report. So that's one thing we'll recap again. We've shared our thoughts on those numbers being bullish because of the placements down to a 4-year low, sharply below expectations. Within those numbers, though, some optimism for what's ahead. When you factor in the lower percentage of heifers on feed, some signs ahead we could be starting to gain some traction in rebuilding this herd later this year. But at the end of the day, we've had that good couple of sessions higher, gapped open up at the start of the week. We stalled out at various points of resistance on the chart today. And I think in a bigger way also priced in some more circulation about this news concerning the bird flu, something that also broke yesterday and in part took the market off its highs. Some talk about the avian influenza being found in pasteurized milk now, had been detected in unpasteurized milk before. Still some different movement restrictions in place for dairy cattle. No, I think, severe concern about any risk to beef or milk for the consumer, for that matter. But it's enough of a reason after a few big up days for these speculators to want to step out of the market and see what's next in terms of this news. And it's always important to note, too, that the recent rally had caught the board up to where the cash trade was at, both live cattle up to 182, 183 for nearby futures, feeder cattle up towards or just above the real-time feeder index at 242 and some change. So it's a pause and see what happens now with this cash market, as it will develop more fully today. Also, a pause and see, like for the hogs here, as they came off of their early highs, what are we going to see out of this cold storage report later this afternoon?
And it's not hard to imagine the consumer being a little wary when the government says, don't worry about it. Nothing to worry about. It's fine. It's not active in the pasteurized milk. But given the track record over the past few years, I can understand why there would be a little bit of concern there.
And that's the
On the
biggest
other
thing.
hand,
So,
when you look
yeah.
at the hogs, were they following cattle today, or what's going on with hogs now?
In part, early on, you had some of that benefit from the spread, as we've detected more lately when there's an injection of risk about beef and concern about the bird flu. That can momentarily, at least as it did early on, seemingly boost the hogs as we think about consumers maybe rotating additional demand towards pork, which had already started to occur, at least as an idea, as an expectation, because of beef prices having recently outran pork costs for the consumer. But you bring up the consumer and the pushback there, and a bit of questioning about all of this news. That's really what we know could be the thing that gets in the way of what is still a fundamentally bullish market. And that could be said for both cattle and hogs because of the supply fundamentals tightening alongside robust demand, until you get to a point where maybe if there's worry about what's going on with the supply or bigger risks about bird flu, or in a maybe bigger way, in my mind, if there's overall concern about the economy not holding up, that's what could get in the way of further strength here that would otherwise be possible for these meats going forward.
All right. Well, thanks for explaining everything, Joe. Good to visit with you again and enlightening us on what took place at midweek here in the markets. That is Joe Camp of Comstock Investments, and that'll do it for this episode. Thanks for joining us once again. For producer Breanne Hendrickson, I'm Marlin Bowling. We will catch you next time on the Comstock channel.
Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.